particular budget, it was rife with all kinds of rumours.
There's a lot of negative energy and a lot of scaremongering around what was going to happen.
It's a tax hike for everybody, but the government are saying they've done it to landlords. It's not just landlords. Demand is already off the scale, so it's only going to get even bigger in terms of any available rental properties.
That big shift to a more professional setup all ties into the narrative of obviously investing for the long term and getting set up correctly from the start.
More than 50 to 60% of buy-to-let properties, investment properties, are now bought through limited companies. Something that's gone completely under the radar, believe it or not, is that.
Today, we're going to break down the latest UK budget and talk about what it really means for property investors. Every budget always brings changes that can affect how much tax you pay, how you structure your portfolio, and ultimately the decisions that you make going forward. Now, to help us cut through the headlines and understand the practical impact, we're joined by Simon from UK Landlord Tax. Simon, you work with both UK and international investors and help them translate these tax changes into clear, actionable guidance. So getting straight into it, when you first looked at the recent budget headlines, what stood out to you as the most meaningful change for property investors?
Okay, so I think now that the dust has settled, I think the biggest changes was the changes to the tax rates on landlords who own property in their private personal names. They've now, for the first time, brought in a different tax rate for rental income. So every other sort of income is taxed at the rates of 20%, 40%, 45%. For income from rental property, they've increased it by 2%. So it's now 22%. 42% and 47%. So that has been the biggest change. In conjunction with that, they've also then upped the dividend tax rate. So if you own property in a limited company and withdraw profits by way of a dividend, the dividend tax rate has gone up similarly by 2% to the current bans that were there. But something that's gone completely under the radar, believe it or not, is that in increasing the dividends for limited companies, it's not just landlords they've taxed higher, it's everybody who owns a limited company. So as you know, the UK has a vibrant small business environment. There are literally millions of small businesses out there. They're not landlords, they're just your normal business, like yourself, perhaps, and, typically the directors will take a minimum salary and then withdraw the rest of their money by way of a dividend. They are also now caught up in this extra 2% on dividends. So it's something I find that the national press, the financial press, have completely misunderstood. It's a tax hike for everybody, but the government are saying they've done it to landlords, but it's not just landlords.
Yeah, interesting. I think it's, like you say, that was the main one that stood out for us. And it was very much directed at landlords, right? Yeah. But as you say, it affects a wider range of people. But I think part of this budget has actually been, and maybe even having this conversation with clients, is what didn't actually come in. There was lots of conversations around stamp duty was going to change, which I think that, that would have had a much greater impact.
Yeah.
But are you having those conversations with your clients as well, where perhaps you might have had quite panicked clients pre-budget and now maybe they feel a little bit more relaxed now that they know what the landscape looks like?
Oh yeah, absolutely. I mean, prior to the budget, as you know, this particular budget was rife with all kinds of rumours. That in itself is causing almost a kind of like a paralysis, I think, you'd find. But post-budget, most taxes didn't change for landlords. The only ones that did change were the ones that said on, rental profits by 2%, and on limited companies by 2%. But interestingly, limited company landlords are in a strong position because, of course, they can choose the level of dividends that they need to take out.
Yeah.
So for them, practically the change has almost gone unnoticed. Most of the clients that we have tend to withdraw profits from their rental profits in their company as and when they need. So they literally avoid having to pay the higher rates of tax.
I guess, Simon, quite a lot of landlords are a lot more sheltered from this increase of 2% for those who are holding it personally, because Since 2016, George Osborne brought in the sort of interest relief being waived, and people from, for 9 years now have started to be more incorporated. Being a landlord's become more business-like. People are taking it more seriously, building slightly larger portfolios. So I guess it's just all kind of heading more in that direction. This last budget is kind of nudging it even further in that direction from what this needs to now look like for landlords who are setting up or managing their portfolio.
Yeah, absolutely. I mean, the transition from ownership in personal name to limited company is, I think at the last survey that I looked at, more than 50 to 60% of buy-to-let properties, investment properties, are now bought through limited companies. And that trend, I think, is only going to get bigger and bigger, particularly after the budget. But it really comes back to, the limited company does give landlords a lot more flexibility to navigate their way through these changes in a really good tax efficient way.
It's what we've been speaking about a lot, not just on this podcast, but other conversations we've had, is just that big shift to a more professional setup, which all ties into the narrative of obviously investing for the long term and getting set up correctly from the start. I guess one of the other ones to touch on, even though, it's not a major one, but it's certainly one that grabs headlines, is the mansion tax. Is that one where you're having many conversations with people about that?
We don't have many clients who are letting property worth 2 million.
Yeah.
We do have some, believe it or not. Yeah, in central London in particular. But I'll be honest with you, that kind of investor, it's just not even registering.
Yeah.
Yeah. I mean, it's a lot of money, starting off at, I think it's £2,500 going up to £7,000, but it's not coming in straight away. They're going to figure out a way of adding it on there. A £2 million property, the monthly rentals on that are substantial.
Yeah.
I don't think that's going to put off a lot of people. And that's my experience so far.
Simon, it'd be good to get your thoughts. Obviously, we've already mentioned the lead up to the budget, and we kind of felt this as well. There's a lot of negative energy and a lot of scaremongering around what was going to happen. How do you feel the sort of mood in the camp is with landlords going into next year? Are you having lots of conversations with landlords who are feeling particularly optimistic about the next year, or not really?
Surprisingly, you might. I can only tell you the conversations I had. We're seeing an uplift. And I'll tell you why I think that's happening. The fact that you've got the Renters' Rights Bill, now the Act come in, you've got the changes to the tax rates. The cumulative effect of that is that your accidental landlord is more or less dropping out of the market. And by an accidental landlord, I mean someone who had no intention of becoming a landlord. They've either inherited a property or they've got into a relationship where they both own a property, they've moved into one and let the other, or bought a third property. And whilst back in the days of 0.1% interest, it almost seemed like, money for nothing, those days are over. Yeah. Mm-hmm. Those landlords we've seen, they are the ones that are exiting the market. They weren't really, investors looking to invest in property to begin with. The landlords that I tend to see are the ones that, people like myself, we've seen ups and downs. I've seen 3 recessions in my lifetime. They are not going anywhere. They are buying more. Yeah. And they continue to buy more because they can see actually what I can see, which is the culmination of all this means less competition. You've increased our costs, and sooner or later that cost will have to bear itself out in some way or form. Demand is already off the scale. So it's only going to get even bigger in terms of any available rental properties. So for, serious landlords who see property as a long-term investment, I think you'll be surprised at how buoyant the market will become. And it only takes another 1 or 2 drops in interest rate for suddenly a lot more people to see investment, for what it is, a good long-term strategy. Yeah. I mean, a slight drop in interest rates will be, more than compensate for the increases in tax that people are having to pay. So I think there's a lot of moving parts. And I think, in the next year, as we see a drop in interest rates, which is predicted, then I think the market will certainly start to pick up.
Yeah, I think it's very much been a buyer's market, and those that have been looking to sell are generally people who've been forced to sell.
Yeah.
And those that have been able to sort of weather the storm, I think there's certainly brighter days ahead, not too far away. In terms of what you do, and we've spoken about previously, limited company setups and structuring yourself for the long term, is there anything that came out of the budget that either reinforced that, or is there anything, even with the rumours circulating perhaps, that made you think there were particular ways to almost future-proof investments?
Fundamentally, the landscape didn't really change. For a number of years now, the limited company route for long-term investors was probably more reinforced as a result of these changes.
Yeah.
Simply because of the fact that although there's an increase in the personal tax rates, which you can't avoid, you can avoid the increase in the dividend tax rate. The corporation tax, i.e. the tax on profits, stayed the same at 19% on profits up to 50,000. It's the tax on when you take the money out of the company that went up. But for a lot of investors, they're not looking to take money out because they don't really need it for the day-to-day expenditure. So they can afford to leave it in there. And as we know, in 3 years' time, there'll be another election, and who knows what might happen then. The landscape may change, and you may come back to a situation where some of these punitive changes are reversed, etc. Stamp duty is reduced and things like that. So it gives clients investing through a limited company a lot of flexibility to retain the money in their control.
Yeah, I think it's all just reinforced the idea of actually, particularly if you're buying for the long term, multiple properties, it's just reinforced the idea of buying through the correct sort of limited company structure.
Absolutely, yes.
Simon, thanks again for coming in and talking with us about the budget in this video. I think for anyone else listening to this who's still got questions or still unsure on anything, then there'll be a link below in the description. Click the link and you can get in touch. And Simon or ourselves will be able to help with any of your questions. Thanks very much.
Thank you.